Are we live right now? Would you believe that it's a little over 2 weeks before tax time now, and we're a little over 15 months into this COVID crisis, and here we are looking at one of the biggest in US history drop in stock market value and the largest, most significant recovery in recorded time in the stock market. Welcome everyone, I'm glad you're here, and we're going to cover some economic questions and business questions with regards to the economy, expected performance of investments, inflation. These are just a few of the things that a lot of you have asked over the last few months, and I felt it was time to address some of these questions collectively and give you some of our group thought and some of the best information we've gathered from various sources. And I want to give some thanks to my staff for helping organize some of this, especially Troy Crutcher, my son Dalton, who now works with us, and Jake Blucas and Jeremy for some of the help. And I've went around the office and asked questions of what many of our clients are bringing up, as well as from my meetings. And so we've put together what we feel is the most pertinent to you and what we think a lot of you are thinking about going forward, especially in this coming year. So let's go ahead and get started. We have some PowerPoint slides to go through with you, and we're also going to open this up to questions you may have, so that just while I'm here previewing some of these slides, PowerPoint slides, and some of the points I want to bring up, just go ahead and type in some of your questions, and I'll be addressing those as we go on. Dalton, you want to hit slide number 1 now? So here we can see what I just referred to as the biggest stock market drop in US history and subsequent recovery. We were reminded by many from many different financial sources that we would expect a recovery sometime after the entire country, if not the globe, had been vaccinated. And here we are, the fastest vaccination point that any of us have ever seen. And also a recovery that happened, not quite a K recovery, as you can see here often referenced, but a V-shaped recovery in the stock market. The economy has also been growing through this massive shutdown phase, and you can see this happening by the end of March, early April. We had seen an almost entire recovery in stock market value by early fall. By the September period, full market recovery and continued growth in major cyclical stocks, small, mid, and large, and global as well. So we can see this slide to help us get a visual of those significant drops and then immediate recovery almost. You want to go to the next one now? This is a 2020 market rundown I wanted to run through with you folks. And go ahead and ask some questions as we go through this if you have any as well. So the market drivers that one of the things that we saw early on in this with all of you was, my goodness, how is the GDP rates going to stay up with shutdowns, and the government seemed to be contradicting themselves in terms of wearing masks or not to wear masks, and whether to shut businesses down or not shut them down, conflicting information from restaurants about whether or not some states had success from shutting their restaurants down, lots of different conflicting information. And I think that's reasonably expected with the first time that we've all ever gone through anything like this. And massive stimulus was on its way by April. And United States, as you might recall, in February had shut down all flights from Europe coming in about the middle of February, except for the UK. And that was one effect of the would have an effect on the economy, but the other would be all of the shutdowns. But we had a stimulus that I think was timely, and if there was ever a time to have massive stimulus injected into the economy, that would have been a good time to do that. So we had a recovery, many believe, partly because of that infusion of cash into the economy. And then we also had 18 to 24 months before that, recent tax reductions. And those reductions were very confusing to people. We heard lots of different contradictions from different media sources, especially. But those tax reductions affected the lowest income wage earners all the way to the highest. And the largest percentage of tax reduction was in the middle. Also, we saw corporate tax reductions, and we also saw a push towards reduction in growth and regulations. And so those were stimulative to the economy, and I think were accretive in some form to the drops that we saw in the early spring last year. Consumer sentiment is something that's often not described, but that is, I think, a huge effect on the stock market, the housing market, and the economy at large. So the consumer sentiment is high, especially last month's numbers that came out. And that wealth effect it's a lot of consumer sentiment is coming from the wealth effect. And the wealth effect is felt by homeowners from the increases in value of their homes and also their stock portfolios. So those that have remained diversified own some fractional ownership shares in for-profit companies through index funds, mutual funds, individual stock ownership, have been very well rewarded from the recovery we saw in April that started. And so that wealth effect also stimulates the economy. That also helps the consumer spending as people feel better off. Vaccines, that's a huge effect. People getting vaccinated is likely to help hold down some of the spread and even reduce or possibly we many of us, I think, hope eliminate it. Interest rates, I think interest rates could possibly be the number one reason for market driver. Low interest has proven through many different business cycles, looking back in excess of 100 years of data, have shown to be the biggest driver in economic growth. But you cannot hold interest rates low forever. And it does punish the savers who want secure money in CDs, money markets, savings, checking accounts. They're punished with, of course, no interest at all after you adjust for inflation, especially. So 0.1% is what we see in a lot of savings accounts from money markets, CD rates held down below 1% for 1-year CDs, things like this. That low cost of borrowing money can be very helpful, and often, usually it is, to growth in the economy, though. And while it punishes, again, the savers, it is a very stimulative effect on corporate growth, job growth, growth in just about every form you can imagine, housing and so on. So that's why you might read a lot of information in different periodicals about what the Federal Reserve is about to do with interest rates. That has a significant effect on growth in the economy. Low consumer debt. We have a period right now where consumers have pretty clean balance sheets, especially when we look through time and go back to a recent period such as 2006. We can see that consumer debt right now is reasonably low. And we can see historical references to that point as well. So we can look at resources such as the M1, M2, and M3 money supplies. We can quickly put those into a search toolbar, and we can see that consumer debt is pretty low right now. So that acts as a buffer to significant market shocks like 2007 and 8, when we saw a housing crash, real estate significant drop in value. The consumer debt was pretty high then. So now consumers have pretty clean balance sheets. We do read a lot. I think a lot of you might have seen some articles about corporate debt being very high. There's another side of that story that I'm not a fan of debt, by the way. There's another side of that story, however, in that when you can borrow money at very low rates and your firm or your company is really growing, that takes oftentimes, especially in manufacturing, significant capital. And when you can lock in 5-10-year rates at historically low interest cost and grow that way, that is additive or accretive to the performance of your company, the profits, increased cash flow, and growth. So maybe the next slide. Do we have any questions on any of those points right now? I have Dalton with me organizing the slides. Market risk, we have client resilience in the spring of 2020, when Jake and I and Troy and Jeremy and Dalton sat down and thought about some ideas that we thought were brought up mostly in meetings with you. We thought that this would be a great opportunity for those of you watching to give you some credit for the spring of 2020. I was a little bit surprised that so few, there might have been 3 clients that expressed deep concern of risk of loss over an extended period from your portfolios. Very, very few seemed panicked or extremely concerned. I credit that with seeing how well diversification has worked for you through the years, and your trust in us as your trusted advisor to get you through some of these panic periods. And if there's anything a good advisor can do, is to have an explanation for what is happening to your investments during certain phases of time, and have a reasonable, rational explanation, and offer investments that are not correlated to the steep downturn. And so we did have some significant return in our bonds last year, and a lot of our bond performance was up 7% or more throughout 2020. And that was very reassuring to many of you to see that despite the bond yields at 1% or less, your bond prices had produced a return for you of over 7% throughout 2020. And that was part of, I think, gave some encouragement to many of you to see some positive performance during that 2 months roughly of serious downturn. How will national debt possibly impact the market? I want to address that question right now, because I think that gets asked a lot, and it'll be asked more. That's a great question. So what happens when the government has massive debt, and it becomes so massive that a significant amount of our GDP is going towards paying the interest on that debt? Right now, the day of reckoning is nowhere close with interest rates as low as they are, but someday it will come. And what it does, first of all, I'd like to remind all of you that it reduces the standard of living to the citizens in the country that have very high debt burdens. It reduces the standard of living because it infringes upon job growth, wage growth, just an entire standard of living defined by many in different ways. But it's basically the cost of interest goes up, the cost of borrowing money goes up, the cost of capital goes up. and the value of the dollar goes down. So the cost of importing goods such as cars, whatever you're buying that's imported, goes up. That could be energy cost if you're a net importer of energy. And again, your burden of servicing that debt becomes more and more significant as time goes on. Some industrialized nations, such as Japan, have a GDP to debt ratio of over 200%. That's been the case for over a decade, I think now. United States is around mid 90s of debt to GDP ratio. That's national debt. And what it's going to do is raise interest rates eventually as we incur more and more debt. Our interest and cost of servicing that is likely going to have to go up. If I were to guess right now, I would say that's 3 to 5 years from now would be my best guess, that you start seeing the 10-year bond yield going up. That's the cost of interest often impacting mortgages. So the impact on the growth of the economy, it's much harder for an economy to grow. So it impacts directly people's wages and the unemployment rates, indirect maybe on unemployment rates, but you'll start seeing a lot of European nations, 10% unemployment as the norm accepted there. You'll start seeing more and more of that, I think, maybe in a decade or two, if we don't get this debt under control. Interest rates, so we can see interest rates are very low historically right now. That has helped enormously, but interest rates going up will have an inverse impact. We'll see if interest rates go up, you'll see, I think, some drops in equity or stock market value. You saw some of your tech sector hit pretty hard in the last month. That's Apple, Google, Netflix, Amazon, Microsoft. And I think a lot of that was to do with the huge run up last year, and maybe even more so from a slight increase in interest rates. So that's going to be, I think, the biggest driver in 2021 stock market performance is going to be interest rates. In inflation, we have very, very low inflation rates. That's confounded a lot of economists. No one has gotten it right on inflation ever in history. Looking through a lot of the writings of some of the early founders of the Federal Reserve in the 20s, some of the first Federal Reserve chair people, and some great minds around economics, they have never been consistent at an explanation of inflation. It's confounded a lot of people, but when you keep printing up more money, it does debase the value of the existing currency. When you keep printing up more and more dollars, and it's dilutive to all of the people that hold dollars, and it has more often than not been inflationary. Now, a lot of the articles and research you'll see out from a lot of great minds in the past few months are writing that it is not going to create inflation, the monetary policy of printing out lots of money, but history has shown that more often than not they're wrong. I have a question here. What are the thoughts on the current Seattle housing equity boom and the future outlook? What's your growth outlook for the next 3 to 5 years with aerospace? Aerospace, I don't have any idea the next 3 to 5 years, but we have a lot of Boeing clients that would know a lot more than myself, and many great minds in aerospace, of course, right around here in this area. I think they'll get more and more appreciated as more stories come out of exporting a lot of jobs in aerospace. The question about the housing market, I think there's a rational explanation in that, and that is that if you look at the amount of permits issued for new housing, and you look at the number of people who own houses right now, and you look at the number of people who need housing, and you know that housing rents are very high right now, then you would know just from deductive reasoning that the end doesn't look like it's in sight, except it always is. And so what you're seeing is a traditional excellent explanation of supply and demand. And this is going to continue likely because of the numbers you can quickly see all over the place about lack of housing. There's just not, and that was predicted in 2010 and throughout the 2012 all the way up to 2015. There wasn't enough housing being built. And now here in Smoky Point, any of you from this Arlington area, and in fact your area, a lot of you wherever you're at around the country, you've noticed that apartments are going up all over and houses are being built all over the nation. And you can see this from permits issued. And so until we can get an equilibrium of housing, you're probably going to see it continued. We had a great discussion with a realtor client yesterday late in the afternoon that said that even in the rural area they're in, that they have 30 offers now on a house. And then we had a client earlier yesterday morning I was visiting with that told me that they have over 100 offers every time a house goes up in Sammamish. So that's enormous. That's just huge. So there's a lot of demand right now and lack of supply. Great question though. So inflation's very low. We're likely to see continued inflation low perhaps this year in the next 2 or 3 years. But again, when you keep printing up money, it is more often than not inflationary. But through gains in efficiencies, technology gains, of course, efficiency gains can be had in areas that aren't always so obvious, such as tax benefits for employers to buy equipment. We've had accelerated depreciation for some time now. Those are stimulative to the overall total economy and make it very conducive for employers to invest in new equipment so that employees have access to the latest and greatest. That does help put inflation rates down as efficiencies across the country and even the globe, but across the nation are introduced. And sometimes those efficiencies can come just from simple tax tweaks in the tax code. And those accelerated depreciation, that means that if an employer is to buy like a new tractor for a farmer or a new copier like in our office, and the cost is $5,000 or $20,000, you get to write that cost off against the business income that year and not take that cost divided over 7 years or even longer. So that's accelerated depreciation that does help flatten the inflation curve. Market risk would be recession. We could, of course, have a slowdown in growth of the economy. Right now, the economy looks to be expanding. It looks to be growing right now. It's possible that corporate profits coming out, especially in the next few 5 or 6 weeks, some big ones start coming out again. We'll see some good numbers. It's very possible. We're getting some signs. Early morning this morning, I was reading Barron's, and there was some good press in there about great profit potential in American corporations. Increased regulations. If we have significant increases in regulations, that can be negative impact on the economy. The market could start going down over some of that as well. A lot of times the stock market is an economic indicator to the overall growth of the economy. It's often ahead of the economy by 6 months. You notice that huge drop we had by the end of April, and that was the stock market expecting some massive slowdown in GDP, and it's true, there was. However, a lot of stimulus checks came out and short-term stimulus to prop it up, quite honestly. Trade wars, that would be potentially hard for our GDP rates to stay up if there was some significant trade wars coming. Those are what we see as market risk. And then the next one, U.S. Treasury yield curve steepens. This is a slide we wanted to show you. It's fairly timely. It goes to the end of February almost. The date, you might be able to barely read that on the lower left. It says 226 on the blue line. And we can see the current yield is very low historically. We can see the current yield from 1 month. We use a term in our industry called basis points. It's kind of a peculiar term. We call, for example, 1% 100 basis points. And it might help you to understand this better if I say that, because 100 basis points being 1%, you'll see in the middle there, 12-month change, 141 basis points. That's almost 1.5% change. And so we can see that over time, the 12-month, or let's look at the yield over 20 and 30 year is 208 basis points on a 20-year, 30-year, 217 basis points. So that's the percentage, 2.17 upper far right to 2.08. And we can see that they're low on the current yield. And that is, again, helping to grow the economy, but they are increasing slightly right now. And can we discuss cryptocurrency? That's a great one. We have decided to do that this morning. So we'll discuss that a little bit later on with a slide I have. Thank you for asking. And we'll bring that one up. This is something to help you see the low rates and the recent trend in a more simplistic chart. So this is what we often use Fred charts, and coming out of the Federal Reserve. And this shows you 2020 and the drop in interest rates. The Federal Reserve did that as a stimulative effect to get the economy going and not let it drop too far. So there are some short-term things that can happen. It's called manipulation, by the way. And does it work long-term? History, in my view, clearly shows it does not. Very short-term, some argue not so much, and some argue it is a good thing in the very short term. History always shows that sometimes when the government's had interventions, such as through the Federal Reserve, through tax policy, sometimes it is proven to be very bad, and sometimes it is proven to be very good. I think when the government mandated what I felt were extreme shutdowns, lockdowns, often termed as, you almost, when you created a situation like that, something had to be done also artificial. So that's why I was glad to see all of the stimulus money, because I felt it was a counterbalance to the artificial measures of shutting down an entire economy. So we can see this in this chart that there's been a recent uptick in interest rates. It started again through roughly end of summer, as I recall, and that graph kind of illustrates that for you there. This is also a graph to help you all see that the money supply, we can look at M1, M2, and M3, which is a term that is actually pretty simple. It is a calculation to try to determine as accurately as possible all of the cash and ownership, all the way up to stock ownership of the American people. So we can see the yellow line to the far right, 2020, that there was a huge, like a hockey stick. I mean, look at that. It went straight up the savings rates of people. And that was again in the form of stock ownership, savings accounts, money markets, short-term CDs, bankers acceptance notes, and so on. So you can see something dramatic. People, I think, out of not too distant memory of the housing crash that we saw in 2007 and 8, and the longest recession in U.S. history. People had a vivid memory of that, I think, looking at this graph, and they pulled in cash. They were not even able to go out to and go and do any shopping to any effect except online, I suppose. So there was a heavy concentration of savings in the middle, starting in the middle or early part of 2020, and it's continuing. You can see it's continuing on. And when that changes is anyone's guess, but I have heard from a lot of you that you intend to do more travel sooner than later. And some of you are quite optimistic about it and have already purchased cruise tickets and so on. And so I think that curve is changing a little bit, and we'll see new spending coming up pretty soon is my best guess. But right now, the savings rate exceeds the spending. Can we, oh, there's a question here. How did the recent stimulus checks going to affect the economy, and will there be a negative effect for the future? You know, there is going to be a price to be paid for this, as we all know. Somebody's going to pay this back. And it's like, I think of it as like eating cotton candy. It feels really good at first, or that bagel first thing in the morning from Costco with all the butter on top of it. I always feel really good right after that for a while. And if I have a whole bagel, I don't feel so good after about an hour or so. But eating cotton candy makes, it's been a long time, but it does, I think, make you feel good for a few minutes, and then the after effects kick in. So the stimulus checks are definitely boosting the economy. You can see the savings rates. Some of that savings rates, it's good to remind you, is into the stock market. So some of the stock market outperformance last year is due to some of that money from savings. We saw places such as Robinhood, E-Trade, TD Ameritrade, Charles Schwab, Fidelity. Everyone had huge inflows. So we had tremendous growth last year because many of you decided to retire. And so that's, you know, savings rates are going up. And that acts as a cushion to recessions. It does make our economy stronger when savings rates are high, despite what you might hear oftentimes that consumer spending is good for the economy. Well, that's true too. Everyone, I think, agrees with that. But also a vibrant savings rate acts as a cushion to bad economic cycles, such as unemployment and so on. So I think the negative effects are in ways that we won't see for some time with the stimulus money. That is, that people have been told all their lives to have an emergency fund. They've been told oftentimes by their parents or someone close to them, you should have a savings so that when a rainy day fund, when the rain comes, or an emergency savings account, and perhaps as high as 6 months or longer of your income in savings, some form of liquid savings that you can rely on. Well, now a lot of people, I think, are being programmed to believe that they can rely on the government to give them that savings. And I don't know if that's ever been sustainable in the history of humanity. So I just think it's kind of a something we're going to have to wait and see how that goes. But letting people believe that they can rely on a bailout and this kind of personal bailout or even a corporate bailout is never consistently worked. So savings rates being high are good as a cushion against economic downturns, because clearly when people are laid off, they have some of their own resources to rely on, and they can find the ideal job that way, not necessarily be pushed into having to accept the first job offer. And I think it's good overall for sure, but that could protect us against a big downturn in the savings rates. Oh, I don't know. That shouldn't be in there. We should get, that's a friend I met. That was from out in the rural area of Mexico. My wife and I, Heather, met this kind critter, and isn't he cute? Taxes, what could result? We've got, it looks like audits are going up. This stems from questions some of you have asked about what our thinking is on the tax reform that's been talked a lot about in the campaign period of last year. So I put audits at top. I think that audits, especially of higher income earners, perhaps 200,000 or more a year of income, are going up. And the reason I think that is because we know from experience that IRS service has just been awful, and there's not enough staff to adequately service, and that has kept them from doing auditing. And so audits are going up. That's one thing to mention. So I know that doesn't apply to any of you. We just want to make sure that our numbers are squeaky clean. Individual taxes are going up. Very likely we'll see something in the next month to fall. If we're going to see it for next year, it's unlikely that it'll go retroactive like it did. I believe it was in 95 to January 1 when it was tax increases were passed in March of that year, I recall. We'll see some individual tax increases, I think. And where I think it's going to be seen is when you saw the marginal rate drop from 15 to 12, then I think you're going to see the 12 go back to somewhere between 12 and 15. You're going to see where the 24 was 28. You're going to see that, or 25. I'm now a little foggy on that. I think the 24 now was 25, but it may have been 28. I think you're going to see an increase in that upper middle income bracket right around the $200,000 income range, upper middle class. And especially those in the higher income brackets in the 400,000 a year, especially, are going to see, I think, increases from the roughly 36, because it's 35.7, I believe, right now, to 39, if not 41 or 42% marginal tax rates. A lot of those people are living in states where there's also a state income tax, so they're going to see income tax rates of over 50% easily, I think, coming in the next 12 months is my guess. Capital gains tax rates. This is something that is going to possibly create a heavy amount of work in our office. That's because your non-IRA accounts, your non-tax sheltered accounts, are going to suffer possibly capital gains tax increases from the 20% up to 28% is my best guess right now. So the reason I said 28%, that's what a lot of tax experts are saying. Also, it's what we had for a long period of time earlier in my career. So I wouldn't be surprised at all to see 20% turn into the 28%, the 15% right now turn into 20%, something around those lines. Also, if your income is below roughly $82,000, married filing a joint tax return, roughly half that amount for single filers, capital gains tax doesn't exist. There is no capital gains tax rate. So I think that'll be changed, and there'll be an introduction of taxes in those tax rates to those tax brackets, those marginal tax brackets, to 15% is what I think. Also, we have a capital gains tax of 28% on collectibles. And I wouldn't be surprised to see that pushed up. So anyone in any tax bracket with a collectible, I always think of my Thor comic book collection when that topic comes up. It'll be a 28%, it'll be larger than 28% possibly on collectibles, regardless of your tax rate. Death taxes, this is often referred to as estate taxes. I prefer to call it death taxes so people understand what it is. We're already hearing a lot of rumors about the current exemption amount is around 5.2 million. We'll see a drop in that to where it's around 3.5, very likely, perhaps even lower. And what that means is that when your estate, everything you die with is valued at more than 3.5 million right now. Again, it's a little over 5. Then it starts getting taxed incrementally, starting at roughly 25% on up, all the way up to 45% right now. But that'll go even higher, probably. Another change in death taxes is been talked about a lot in the last couple of weeks, has been step up in bases. So this is something that's been very precious to all estates, regardless of your income level. When somebody dies and they leave behind real estate, appreciated stocks, they take what's called a step up in basis. So the date of death value becomes the new cost. So in other words, if you had shares in Microsoft at $10,000 and now they're $100,000, when you pass away, the $100,000 becomes the new cost basis. And so there's a lot of talk of repealing that for everyone. And that's what you might be hearing called a step up in basis coming up pretty soon. What capital gains taxes are expected with a sale of primary or secondary home? I've been thinking about that question just last night, and what a sneaky way to increase taxes on everyone, because right now we have a home exemption amount of $250,000, double that for a couple. If you've lived in a home for 24 out of 60 months, so 2 years, and you pay, for example, $250,000 for the home, and you sell it for $750,000, you have a significant run up. The tax rate is 0 on you because you've lived in it as your primary residence for 24 months, and it gets a $500,000 tax-free status. Anything over that would be taxed at capital gains. Now, again, that's $250,000 for a single, $500,000 for a couple. I wouldn't be surprised if we see this changed, but I have not seen any articles about it yet. And thank you for the question, Malad. One other thought I had on that was, one way inflation works is that not increasing over time becomes less and less of a value to you. So I think a lot of politicians are thinking inflation will just take care of that and start increasing taxes on people. Time will tell, but good question. Inflation's been about over a 40-year average, about 4% right now. I know that might be hard for some of you to believe because you're used to seeing 2% over the last 2 decades, roughly. But over the last 40 years, it's been about 4%. It's trended down from about 4.25% a year ago. Now it's very close to 4%, if not barely over that. Again, I mentioned this earlier, that when you print out more dollars, it becomes dilutive to all of us that have money, whether it's in the bank or in our wallet or wherever it may be. As long as it's not growing, then printing out more dollars can be dilutive, and they call that stimulus. They call it different forms, but it's more often than not been inflationary. It does drop the value of our dollar because it's dilutive. We might see some signs of inflation through wage increases. This was a question that some of you have been asking a lot lately. What would be some signs of inflation? And so we use a historical perspective. I certainly like to read and sift through lots of books written just even, believe it or not, about 100 years ago, about past business cycles. People have lived through these cycles. And wage increases has been one of the clear indicators of inflation, and wage increases are healthy for all of us. It's when sometimes they get incrementally very high, maybe 2 or 3 times in a 12-month period or even more. And those are often, you can see through history, cause inflation. So right now, Americans have not seen significant wage increases for decades. They have not seen real significant, other than moving up through your job, creating more value in your workplace, adding more value in what you do. That's the way that you've increased a lot of your wages, I know. But regular wage increase significantly hasn't happened for decades now. That might be changing. We don't know. The minimum wage increase could. We're all kind of learning at this as we go. Value versus growth. We thought it important to bring this up to you because we can see that the U.S. market has gone up dramatically. It was not a K-shaped recovery. It was a V-shaped recovery, as you had just seen earlier. So international markets have not performed the same. Europe and Asia at large, their markets have not recovered the same. They are doing a lot of stimulus as well. Interest rates around the globe are very, very low, as a lot of you know. But the other point we wanted to bring up is that while the stock market has had this huge roaring recovery, not all sectors have. And value investments have always been my favorite. And value investments are often the unloved. They the last 10 years are mainly in banking and in energy. And so we are seeing some clear signs of those are cyclical stocks. We're seeing some clear signs of recovery in that area. It's very uncommon to see an entire decade where they've underperformed in almost every single year of growth, but that has been the case in the last decade. Also, some underpriced, if not fairly priced, investments are emerging from the international and emerging markets. So what are emerging markets? Again, I like to explain what that is, because I don't think a lot of people understand it. That's from emerging economies like America was roughly 100 years ago. So that would be like your Russia, India, Malaysia, South America. Those would be some examples of your emerging markets. And developing would be, you know, France, Germany, UK, Australia, and so on, Japan. We could hit the next slide now, Dalton. This slide, we thought definitely was worthy of bringing to everyone's attention. This shows the IFA Morgan Stanley Capital Index, MSCI, of Europe, Asia, and the Far East. And so this captures the world stock markets, and DISVX is the American is the Dimensional Fund Advisor Small Cap Value. And this is an index that almost all of you have had in your portfolios for a decade or longer. And you can see the S&P just below that. So these three we thought would be germane in helping you to see some of the differences and that I'm referring to in the earlier slide about value growth and international, not so much emerging here. So 3-month, this ends pretty recently here. We can see 3-month 5.8 on the world markets, the small cap value about 12%, and the S&P 5.5 roughly. Year to date, the IFA most closely matches the S&P 500. Small cap value is on a tear right now. Knew it was coming, just didn't know when. Because we knew it was coming only because it was so significantly underpriced for so long. It was unbelievable decade in that asset category. And we also threw that one in there as an example because that is one that we've pointed out to each of you that the performance is not very good when we compare it to, for example, the S&P 500 index. And yet you have allowed us to hang on to that, many of you for over a decade, and your rewards are coming home. I am very, very glad to see that, as you would be. So you can see that EFA across 10 years is about 5%. The small cap value is just barely above that. And yet the S&P 500 is showing 13.5 almost. And the long term since inception shows from 1994 in the middle one there, DISVX, the light, is that a light blue there, Dalton? Is that what that is? Light blue? 7.12%. Now that percentage point used to be closer to 10%, but even higher on an average 20-year run. But the recent 10-year has brought it down. Its long-term average is 7, still respectable. However, the S&P 11% almost since 1970 a year. The international 5.5 since 2001. I think you're going to see the tide changing for the next decade, and that's because not because of predicting growth of their economies and so on, as much as it is predicting because of the undervalued performance for a long extended period that it's almost mathematically bound to change. Global non-US equity annual returns in US dollars, so the way we see them next 10 years. This is a consensus from a lot of different resources, such as Vanguard Group, Capital Group, Barron's even has weighed in on this. A lot of different resources are basically coming up with the same number. Expectation of non-US stocks going between 6 to 8% in the next 10 years, the next decade. So annualized US returns, not so much. Roughly half those figures. Most of that rationale you see is due to the run up in equity prices in US domestic markets. When we look at small cap stocks, we see that's not really the case. I don't have those numbers here for you in the small cap, but they're very, very close, if not even slightly higher than the global US non-US equity. So the inside of the stock market, there's 6 different major flavors in the US stock market. There's your small companies, middle-sized companies, and large companies. And there's also value and growth in there. And so that's why we like to diversify so broadly across those, because they react differently in different times of the different economic cycles. A question: we see more growth in US regards to manufacturing instead of international. Buy from China, i.e. products to put together a product. Well, there is growth in the US manufacturing for sure. The numbers show that it's a very exciting time for a revival in US manufacturing right now. Great question. And we really, we all, I think, hope that that continues. And that is part of, I think, the cyclical change that is happening right now. And you're seeing American ingenuity right in front of you with battery technology and this kind of thing. General Motors has some exciting new technology coming, it looks like, in battery technology. So what has spurred the US domestic manufacturing growth that has been a surprise to many over the last few years? Well, I think it's 2 things: low energy cost and low interest. So let's think about this for a minute. America became a net exporter of energy, primarily natural gas and oil, for the first time in 52 years, roughly 30 months ago. For the first time in 52 years, the United States became a net exporter instead of importer. And a lot of these imports are not coming from our friends. So that has helped catapult manufacturing, as many had predicted. This was all over financial media 5 years ago, that with the shale boom, with a lot of the extraction methods that are very earth friendly now, it was predicted over 5 years ago. It was all over the place that manufacturing would increase and grow. And America was possibly looking down the lens of a manufacturing renaissance, new regeneration, and it happened. And that's what Dave is referring to there. That's a great question. We hope it continues. I'm certainly changing my personal focus, paying much more attention to buying made in America goods personally. I found out last year it was impossible to find the right kind of drill press that wasn't made in America for my home shop. Doing some woodworking, I searched high and low, and I thought I found one, and long and behold, when it arrived, I felt cheated. It was not. It was made in Taiwan. But saying all that, it's a shame that we don't have very many quality tools anymore made in America. And my hope is that changes and continues to change. Will we maintain advantages of low energy with evolving Green Deal of current administration? Will we maintain advantages of low energy with evolving Green Deal of current administration? That's a interesting question. It appears that with battery technology that we're definitely in the running and maintaining a top tier status. If that's where we're at now, I'm not sure. That would be helpful, I would think. But I personally think that America changing to a net exporter and now becoming just recently a net importer of energy is a bad thing for our economy. I don't think it's a good thing when we import our energy, especially from nations that don't love us, that don't like us, and don't treat their citizens very well. And I think you know who I'm referring to. So when we have to import our energy from them, I don't think that's a good thing for anyone, and except maybe the dictator class. So that is going to be a headwind on our economy, probably, Steve, would be my guess. Great question, though. So hopefully you can get a sense. Where are our actions from this right now? This is what we're doing. We're increasing your allocation from 16 as high as 18 international to 20%, and we're addressing perhaps even higher now in international. We're making sure that you're at least a minimum of 4% for your allocation in U.S. small cap value is all there. We're actually going 5% right now, and we're looking at what the risks are with increasing that even more and decreasing your exposure to U.S. large cap growth stocks. That's what we're doing to reduce that risk, we believe, and give you the exposure to what we hope will be even consistent growth that you've been experiencing. Another question. So how might Brexit affect international or the value of the US dollar? That's a great question I'd like to address because it's near and dear to me. My wife being born and raised in England, and her father, Richard, still living there and right outside the town of Chester in Little Sutton. And I started hearing stories 10 years ago about the European Union dictating to Brits, how dare you dictate to a Brit how your water must be boiled, the temperature it must be boiled at on your water boiler, because I'm not sure that there's anyone who doesn't drink a lot of tea in England. So that would really strike at the heart of any Brit, dictating to them what kind of boiler they must have for boiling their water for their tea. But it affected more, I think, a lot of the Brexit. This is when the British voted unanimously to leave the European Union. And it wasn't over economics like a lot of Americans think. It was over, they wanted their own self-rule and as a sovereign nation. And so they felt infringed upon, whether real or not, they felt infringed upon. And so that's what I heard from family over there, and reading through, getting past some of the US media narratives, was able to quite easily see that there was a desire for self-rule in their own national identity. And I don't know that there's any sin in that personally, but it may have a negative economic impact, but I personally don't think so. The reason I don't think so is I don't think it's going to stop anyone from doing trade deals like has always been done through human history. So trade deals between England and France and Germany and other great countries in Europe have not ceased, and nor will they cease based on Brexit is my prediction, but some disagree with that. Next, cryptocurrency. Here we are. So cryptocurrency is something where value is trying to be derived through what's often referred to as chains of data from purchases over the internet and purchases done through the World Wide Web. And cryptocurrencies, right now there's over 80 cryptocurrencies. They've had huge run-ups in prices. There's been some pullback this year, but still they're up year to date on most of the cryptocurrencies. I looked the other day, the top 10 were up year to date. So what cryptocurrencies are is a storage of value through a chain of purchases, and they're a medium of exchange on the World Wide Web and the internet. And what has been happening lately is some academics have been doing a great amount of research on these, and they find some peculiar oddities with cryptocurrency, because some people are confusing these, but maybe not so odd, in that people are confusing cryptocurrencies right now with an investment. Yet when we look at investments, and there's been a great deal of research in economic growth, both daily and weekly and monthly and quarterly and annually and through the years. And when these models are working, they show that with growth, again, this can be done daily, these quantitative models, they show that the currency has a similar ebb and flow with these cycles that even happen hourly. And so what some recent academic research has shown, that cryptocurrency has no linkage with any of this. It's totally agnostic. It doesn't have any linkage like any investment does with an economy. And so eventually, I believe there's going to be a train wreck for the speculators in cryptocurrency. Why have I not been interested in it? Because if I don't clearly understand the value in something, I'm not inclined to invest in it. And so not understanding the value in cryptocurrency, the value add, the way to understand it as an investment, there is no explanation. And so people are making extreme amounts of money on cryptocurrencies, and losses are also extreme. and that'll probably continue for some time. Um, I have no idea how long, but the Federal Reserve can change that anytime they want to. And so I don't know if people who trade in cryptocurrencies are aware of that or if they even care. But the Federal Reserve, anytime they feel like offering some form of cryptocurrency would be a good idea, then all bets are off for the many different types of cryptocurrencies in existence and the types that are coming out all the time today. So I'm not very knowledgeable in cryptocurrencies, but the big takeaway here is I think that um, when you look at the linkage between economic growth or profit of anything, there is no linkage. Countries are starting to ban crypto, could be a warning for the future. Well, yeah, we have read some of that. I don't think banning it is necessary. It's nice that if people want to do that, they can. I don't know that there's any sin in that at all, or anything wrong with it. It just doesn't fit, as an investment. It doesn't fit any of those parameters. Academics have been busy at work right now, writing lots of academic research on this, and it just does not fit any of the profile as an investment. Is there a chance that the dollar will remain as a standard currency and something to replace it? Well, that's talked about a lot. Really, really good question. The U.S. dollar is the standard of currency around the world, and if you look at the most used denomination in the world, it's the $100 bill, the Benjamin. And if you live in a country where you can't trust your banks, which is the majority of the world's population, and you have shenanigans through inflation, through printing out lots of money, through changes in currency. There's been at least one I know of in a major emerging market. You have ways that people can't have any faith and confidence, and so the U.S. dollar's been the reigning supreme form of protecting your money, and as long as that continues, then Americans can get super low interest. We can print out that dollar, and a Frenchman, for example, can carry a Benjamin in their wallet, and we're not paying them any interest for that. So we're getting access to their exchange for that Benjamin in their wallet, and we're not paying them anything in compensation for holding that. Well, we get their dollar to exchange for it. So what that does is that strengthens our economy in a roundabout way. But when you have that happening in trillions of dollars, then it's easier to understand. It's huge. And so the question here, I think that has a lot to do with the overall total strength of our economy moving forward, to do with currency. And so as long as we never default on our bonds, as long as we have a fairly clean balance sheet, then it's likely that our dollar will reign supreme. But that's been called into doubt more so lately, I think, with the types of stimulus things we've done. We've now are ready for President Biden to make a new presentation next week for the next build back better type of thing for infrastructure. We're curious what we just know is going to be probably a huge free-for-all in spending. Curious where that's going to go. I certainly don't have my hopes up for that, but I hope the majority of it goes in infrastructure. We're hearing it's around $2 trillion, I think, is what a lot of Americans are told right now. I just hope it's not into a lot of useless earmarks and things like that don't do anything for jobs or anything to build up our infrastructure. So saying all that, those types of things debase the value because they link us as if it goes into rabbit holes and doesn't go into building infrastructure. It goes into things that are not productive. And then what happens is, it's just a gradual decline in living standards and the value of our currency worldwide. So I hope that you all have learned something from this. I hope that we've answered your questions as something meaningful for you to spend your morning with us. And I'm not sure how many are in attendance, or if you can tell right there, Dalton. 70 of you are here still on board with us. So I'm glad you're here, and we look forward to what the future holds for us. God bless you all.